The financial world is sounding alarms as gold and silver hit record highs amid aggressive federal rate cuts. For decades, precious metals rising signaled uncertainty, but this time the charts indicate something far more destabilizing. Investors, central banks, and foreign governments are no longer waiting for reassurance. They're preparing for impact. The Federal Reserve's sudden pivot from tightening to rapid rate cuts shocked economists who praised a strong economy. If the economy is strong, why cut rates faster and deeper than during several past recessions? Because behind polished podiums and curated speeches, the real numbers paint a much darker economic landscape. America's debt servicing costs now exceed defense spending, something unseen in the nation's financial history. Rate cuts temporarily reduce pressure, but they also signal vulnerability markets are trained to smell instantly. Gold hitting new all-time highs is not enthusiasm, it's insurance against systemic failure. Silver's breakout is even more symbolic. Industrial demand colliding with monetary panic. A rising gold price whispers concern. A rising gold and silver combination screams global distrust and fiat stability. Central banks have been buying gold at levels not seen since the 1960s. That was the exact decade the global monetary system fractured and lost its precious metal foundation. Today's accumulation is not diversification, it is preparation for a world without dollar dominance. Foreign trade partners see the rate cuts as confession, not policy, a sign of underlying weakness. Countries quietly settling energy contracts in yuan, rupees, and dirhams prove the shift accelerating. Just 10 years ago, alternative currency settlements were fringe experiments. Today, they're normalized transactions. The dominoes aren't falling violently, they're falling quietly, strategically, diplomatically. The US dollar's power wasn't built on ink and paper, it was built on trust. Trust that the currency would store value by stability and outlast geopolitical storms. But trust evaporates when trillions are created. Policy swings reverse overnight, and inflation remains weaponized. Investors now fear a trigger event, the spark that turns concern into crisis. Historically, trigger events are never recognized by the public until they become unavoidable headlines. In 2008, the warning sounded a year before the crash. The public learned afterward. Today's indicators echo those patterns, but with global debt 3 times larger than 2008 levels, rate cuts should make markets breathe easier instead. It made metals skyrocket. When safe havens move aggressively, markets are voting with their money, not their mouths. The disconnect between official narrative and actual investor behavior is reaching its breaking point. Gold doesn't lie, silver doesn't exaggerate, and charts don't care about speeches. Every financial collapse shares 2 early symptoms: rising metal prices and declining confidence. The Fed's toolkit is now a set of recycled solutions for unprecedented problems. Rate cuts stimulate borrowing, but borrowing is already saturated. Every household feels the consequences. Businesses carry record debt, consumers struggle with credit dependence, and governments lean into printing survival. The stronger the stimulus, the weaker the long-term currency becomes. That rule never changed. History proves no fiat currency has survived unlimited expansion. Not one exception exists. The dollar is not dying, but it is aging, and aging quickly under pressure. The fear isn't collapse tomorrow. Fear is the system reaching irreversible momentum. Once confidence breaks, charts accelerate, and policies chase panic rather than control it. Foreign central banks store gold because gold requires no trust and cannot be defaulted. Silver rising marks something critical industrial necessity, merging with monetary protection. Rate cuts devalue savings, punish workers, and reward debt-heavy institutions, widening inequality. Every stimulus buys time with debt, time that eventually demands repayment or restructuring. Investors aren't cheering the rally, they're preparing their lifeboats before the storm appears overhead. Corporate insiders are offloading stock while retail investors are told everything is perfectly healthy. Gold outpacing inflation rates signals fear. Silver outpacing gold signals urgency. Trigger event could be geopolitical conflict, a debt ceiling standoff, or a major banking failure. Trigger events don't cause collapse, they reveal vulnerabilities long denied by officials. The public sees green tickers and believes the storm passed. Meanwhile, the foundation shifts.
Add rate cuts.
Today are not solutions, They are alarm bells disguised as relief. Countries stockpiling gold or voting against the dollar without casting a public ballot. Metals rising together have historically preceded currency transition phases and reserve realignments. The United States once replaced Britain's pound under similar signals and shifting trade dynamics. No empire believed its currency would fall until trade partners stopped believing first. Today, trust is measured not in promises, but in tonnage stored underground. The world is transitioning from financial optimism to financial insulation rapidly and discreetly. The question is no longer whether nations are preparing, but whether individuals are. Gold and silver reveal patterns governments speak around, but never directly address on camera. A trigger event does not warn. It exposes, expands, and accelerates pre-existing fractures. Financial history repeats because human behavior repeats. Fear and confidence shape currency more than policy. A soft decline becomes a hard landing when trust evaporates faster than interventions restore it. Understanding metals is understanding psychology. Panic is louder than stability every single time. The strongest financial defense is preparation made before preparation becomes popular. This moment in monetary history is not a headline, it is a turning point. The Federal Reserve cannot produce gold, cannot mine silver, and cannot legislate trust. If stimulus becomes dependence, and dependence becomes permanence, currency becomes the sacrifice. Gold surge, silver breakout, and emergency rate cuts are not random, they are coordinated signals. Signals that institutions understand the system is adjusting its valuation of risk and reward. The public will react late, as always, when hindsight becomes consensus. Those watching metals today understand the translation. The world is pricing uncertainty. 3 takeaways define this moment. First, rate cuts are not rescue, they are response. Second, gold and silver rising simultaneously indicates structural revaluation, not temporary volatility. Third, trust determines currency lifespan, and global trust is quietly migrating elsewhere. Whether this becomes reset, transition, or collapse depends not on charts, but decisions. The warning isn't to panic, it is to prepare intelligently before preparation becomes reaction. If you found value in this perspective, share it. Others deserve transparency before headlines rewrite history. Like this video, subscribe for deep financial analysis, and stay informed during monetary shifts shaping tomorrow.